I want to rehash what you just said, because the real estate joint venture, this is a new concept that you just told me about this past year. But again, I'm a pretty experienced investor in what people tend to do is they tend to do what's worked in the past for them, right? So like I've done things successfully and I keep doing those things successfully. And so sometimes, most of the time, all this other stuff out there is noise, right? It's noise. But really, if you look at music, what is music but ordered noise, right? It brings a structure to noise, and it's right. It creates music. It's beautiful sound, right? So you do have to have your eyes open to these new concepts. And this, to me, was a big new concept that we started to talk about, the real estate joint venture. But I'm going to just communicate it back to everybody. So I'm going to use an example. I don't have, let's say, a ton of money in my IRA, but I'm an active real estate investor. And let's say I have 20 grand and I find a good piece of property. Let's say it could be residential or commercial, right? There's no limits. There's no rule saying you can't invest in commercial property or raw land or a mobile home or a mobile home park or an apartment building, right? I mean, real estate's a broad category, but I have 20 grand and I'm out there and I find a deal. Let's say I find an office building, small office building that I can buy, let's use apartment building, because we're going to encourage Realeflow. We're going to encourage people to really get into residential a lot more than we have even in the past, just because of COVID and coronavirus. So let's say that I find an 8-unit apartment building for $500,000, but I only have 20 grand in my IRA. I can go and find a partner, real estate joint venture partner is what you're calling it, who has the rest of the money, who has $500,000, and I could put my 20 grand in. They put 480 grand in potentially, and we partner on the deal, and we fix the property up. We either rent it out for significant cash flow, or we sell it. We flip the small apartment building for, let's say, $1 million. So purchase cost was $500,000. We acquired the property and we fill it up with tenants, and then we sell it for $1 million. So that $1 million, $500,000 is profit. So I could take my 20 grand and turn it into 250 grand in that example. Does that make sense?
Yeah, you got it exactly correct. And yeah. I'm really glad that you used the figure of $20,000. You used some substantial skin in the game. I don't want anybody to get the wrong impression that you could open up a Roth and put $100 in it and put $100 into a deal like that and make $250,000. That could raise some concerns. And it's a bit in the gray area. And certainly I don't want to get too far in the weeds on that. But by and large, you want to have skin in the game. So a $5,000 investment, a $20,000 investment, okay, that's skin in the game. And now you made that $250,000 profit. The only thing I'd add to that, Greg, so people don't get the wrong impression, especially those out there that are a bit more experienced with self-directed IRAs, that type of fix and flip deal, very short-term fix and flip deal, you would only want to do maybe 2 of those deals a year. And if you're going to make $250,000 in profit with a $20,000 investment, maybe you only want to do 1 of those deals a year. There's not a clearly defined, if you do more than 2, you'll have an issue. If you do 2 or less, you won't have an issue. It's a bit of a gray area. And what I'm talking about here is what's called unrelated business income tax. So if your IRA starts running itself like a full bore business entity, like for example, if I go out and do all of my flips that I did last year in my IRA this year, and let's say it's 15 of them, ultimately the IRS is going to step in and say, you're running your IRA like a commercial entity, like a commercial business. So the IRA is for investment purposes. And that's why investors follow the rule of thumb of not doing more than 2 of those types of transactions a year. All of that being said, Greg, rentals, private lending, that's all passive investment, right? That's all passive income coming in, interest income, rental income. So I have a client, for example, here at Equity Trust, a husband and wife. About 10 years ago, they rolled over 401ks into the traditional IRAs, they have Roth IRAs, and they have 14 rental properties in their portfolio. They have over $1 million in properties and cash. And they have $136,000 in net tax-free cash flow coming in every single year into their Roth IRAs. And they don't have any of these unrelated business income tax concerns because those are all passive income generating investments.
So would we break this up? So there's no limit to how many of those deals you can do a year. But these, in my head, these types of what I call like home run deals or real estate joint venture deals, you want to try to limit those. You don't want to do everything you are doing in your real estate business in that fashion in your IRA, because then you're running it like a business, essentially, is what you're saying, that using your exact words. Yeah.